Let's talk about eInvest. This is an Aussie company that offers active ETFs for Australians, and they've partnered up with other investment managers like Perennial and Daintree Capital to offer these ETFs. And in the future, they're going to be bringing out some new ETFs as well. But for the time being, they only have around 5 ETFs, and we're going to go through each one of them to see what they're all about. And I'll show you guys a way to buy all these ETFs completely brokerage free using a new broker which is CHESS sponsored as well. More about this in the video. Hey guys, my name is Fyzee and this channel is about finance and investing. Before we begin, this video is not financial advice. I'm not a financial advisor. We are speaking in a very general sense only. This video is for informational purposes only. Let's get into it. So eInvest basically has 3 main fixed income funds. So let's talk about these one first. Starting off with the lowest risk fund called ASX ECAS. This is the Cash Booster Fund, which is a managed fund, as you guys can see. And the whole purpose of this ETF is to give you guys high capital stability, which means that the prices for this ETF are going to be stable for the most part. At least that's the aim for this ETF. Now, of course, this ETF tries to invest in stuff like fixed income securities, bonds, short-term money market securities, and other sort of securities as well. And it's mostly suited for a time horizon of about 1 year only. It's not really meant for those long-term holds because the returns are not going to be that high. Now, this ETF is mostly a low-risk ETF. I wouldn't say that it's an alternative for a savings account. It is definitely more risky than a savings account, but it's less risky than other kind of broad market ETFs that are out there. So as you guys can see on this graph right here, ECAS is basically the lowest rated ETF out here. It has the lowest risk to reward ratio, as you guys can see, and it is basically targeting the return of the RBA cash rate plus 0.5% return per year. So what that means is that if the cash rate at the moment is 0.1%, and if you add in 0.5% on top, basically they're targeting a return of about 0.6% per year after fees and costs. And this ETF is managed by Daintree Capital, if that makes a difference. Now, when it comes to the actual specifics of this ETF, the fees that you're going to be paying are going to be about 0.15% per year. And in terms of the distributions or the dividends, you will be getting those dividends monthly, which is quite good in terms of cash flow. You won't get those dividends quarterly or semi-annually or even annually like you do with other ETFs out there. So it is kind of like a savings account in that sense where you get monthly distributions. They paid out around 3.1 cents per actual unit in terms of dividends, and if you multiply this by 12 and then you divide this by the current price of this ETF, you will get a return which is somewhere around 0.75% per year. So it is very close to that 0.6% that they're trying to target if you take out the 0.15% in fees. I hope I said that right. Let me know if you didn't understand this bit. So if you're someone who is super young and you have many decades in front of you, you might want to look somewhere else in terms of an ETF. It's completely up to you. Once again, I'm not telling you which one to buy or which one to not buy. It's completely up to you. This ETF can be used as a defensive tool for your portfolio to make the overall risk a bit more lower, to basically make the portfolio more diversified and balance out the risk. Or if you're a risk averse investor, this can be something that you might be able to use, but once again, do the research. Now, the second ETF that we have on this list is ASX eCore. This is the core income fund by eInvest, and this is pretty similar to the first one in the sense that you will be getting a monthly income, a monthly distribution, monthly dividend, whatever you want to call it. And this again invests in cash and fixed income securities like bonds. Now, this ETF is slightly more riskier than the first one in the sense that it is meant for around holding periods of 3 years or more, and it is not for short-term holds like before. This ETF is targeting a higher return, which means that theoretically it is going to be a much more volatile ETF than the first one. Therefore, they do recommend a longer holding period. And once again, the focus of this ETF is on income generation and capital preservation, meaning that they want to try and make sure that you keep on getting those monthly dividends, and the price of this ETF mostly stays the same. So let's talk about the returns, which are arguably the most important part of an ETF. So in terms of what they're trying to target, they're looking at giving you guys a return of the cash rate plus 2% annually, compared to the last ETF that we looked at, that was 0.5% plus the cash rate. So it is quite a significant bump up from the previous ETF. Once again, having a look at the same graph, we can see that eCore is in the middle between eMax and ECAS. It is slightly more riskier than ECAS, and it is giving you a higher return based on the first one. Now, as you guys can see down here, the fees for this ETF really starts to add up, and currently it is sitting at 0.45% per year, which is very, very high considering that the return that you're getting is only going to be about 2.1%. But just keep in mind that this sort of ETF is not meant for everyone. It is mostly for retirees and those risk-averse investors or people looking to diversify their portfolio overall. it's probably not meant for someone to invest fully into if you're super young, but then once again, it's all up to you and your research. Now guys, let's go into the third ETF on this list, but before we do, I'm going to show you guys a way to buy all these ETFs completely brokerage free using a new broker called Perla. So this is basically a new CHESS sponsored broker, and the whole premise for these guys to exist is the fact that they're really trying to focus on getting people to invest slowly and hopefully getting rich slowly as well. So what they mean by that is that they want to encourage people to invest for the long term through stuff like dollar cost averaging, not day trading. So the newest feature is called Auto Invest, and how this works is that whenever your pay goes in, their system can automatically invest the money for you. They can basically direct debit this from your bank account when your pay goes in, and this can be automatically invested into ETFs of your choice. You can basically set up your own portfolios to make sure that you're investing in the right stuff, and you can also see my portfolio in terms of what I'm trying to invest in, and also some other people on the screen. And if you've been in the finance community and you're following Instagram pages about personal finance and investing, and you've been looking at some YouTube videos as well, some of the names on this list are going to be very familiar to you, and all these guys have set up their portfolio so you guys can click on their profile and actually see what they're buying as well, to make it very transparent as well. Now you can check out this article, I will link this in the description, but basically you can buy free ETFs with Perla for brokers that are eInvest, ETF Securities and Van Eck. You can buy these for free as long as you hold them for a year, but once you do sell them, you will have to pay the $9.50 selling fee, which is their normal brokerage fee. Now if you basically split that $9.50 fee by 2, you're paying less than $5 for buying and selling effectively, which is pretty good, because having a CHESS sponsored broker offering less than $5 buying and selling in Australia is very, very rare. I don't think I've actually seen that. So in terms of what Perla are offering is actually very, very valuable if you are looking to invest for the long term. Now guys, of course, this is not sponsored at all, but I am an affiliate for Perla, which means that if you use my code Fyzee, which is my first name up on the screen, you will get $10 investment credit, which means that you can use your first investment completely free, which means that once you make the trade, you won't pay any brokerage fees of $9.50 for buying the stock. So happy investing. Let's get into the third ETF on this list, which is ASX EMAX, and you can see that based on the risk to reward graph, EMAX ranks the highest in terms of their 3 cash ETFs. So as we've basically discussed previously, if you're happy to take on more risk and more volatility, you may want to have a look at this ETF. It basically offers the same benefits in terms of monthly income and monthly distributions, and it is mostly for defensive investments, meaning that they do mostly invest in fixed income securities, and they try to keep the actual price of the ETF mostly stable. In terms of the investment time horizon, they are looking to invest for a period of 3 to 5 years. At least that's what they recommend that you invest for, because it is going to be more volatile than the previous 2 ETFs that we had a look at. And the main difference for this ETF is that they're looking to target a return of the cash rate once again, plus a return of 4% per year, which is definitely quite higher than the other 2 ETFs, and it's higher than any savings account in Australia right now. Now the main benefit of an ETF like this is the stability, as I spoke about before. So as you guys can see that based on this graph, this ETF fell roughly, by my calculations, around 12% during that crash. Now if we compare this to the ASX 200 index, we can see that for the same period, the fall in price was somewhere around 30%. It was actually more than 30%. So if you are very risk averse, you might want to have a look at this ETF, because seeing a massive drop of 30% in your portfolio is very, very scary to say the least, especially if you're a new investor and you're very new to all the markets. If you've been doing this for a while, it's not going to be as scary, because you're probably going to have the capacity to stomach all that volatility. Now the fees for this ETF are 0.65% per year, and we can see that they're getting higher and higher as we go on the list. And if we actually compare this to other broad market ETFs like A200 or ASX VAS, you can already tell that these fees are very high. But it's very important to note that these are active ETFs, meaning that they're not tracking just an index, and the fund managers are doing quite a lot of work in the background to make sure that you guys get your consistent returns over time. So since there's a lot of effort involved and there's lots of transactions, the cost is going to naturally increase as well. So just keep that in mind. So before we get into the fourth ETF on this list, guys, if you have found value so far, please leave a like or subscribe. It really, really does help out a lot. Thanks guys, let's go into the fourth ETF on this list, which is IMPQ. So this is basically the Better Future Fund, and this is an ethical ETF by eInvest, which focuses on more sustainable methods when it comes to society and environment. And this ETF tries to follow the guidelines of ESG, which stands for environment, social and governance. Firstly, they will look at 1,000 stocks in the Aussie and the New Zealand market, and they have to have a minimum capitalization of about 50 million. Then out of those companies, they're going to try and exclude the ones that are focused in alcohol, tobacco, weapons, all that stuff on that list. Once they have all that, the balance sheet have to be pretty strong as well, and they have to rank pretty high when it comes to ESG criteria as well. And along with that, those companies also have to be making the right investments when it comes to investing in sustainability and basically making sure that those companies are positioned well when it comes to climate change. Now, we've actually covered ethical ETFs quite a lot on this channel, so if you're interested, there should be a link somewhere up on the screen. And most of those ethical ETFs focus on large and mid-cap companies in developed countries around the world. But what makes this ETF unique is the fact that this is focusing on small and mid-cap companies in Australia and New Zealand instead. And this ETF is actually the first ethical small-cap ETF on the ASX. Now, the index which this ETF is trying to beat is the ASX Small Ordinaries Index, and based on the graphs, as you guys can see, it's been doing that so far. So the return for IMPQ for the last 1 year has been around 40%. But if we compare this to the actual index, the 1 year return for that index is 29%. So this ETF has performed quite well. But once again, do keep in mind that we only have 2 years worth of history, and we can't really use this past return as an indication for the future return. But when it comes to the actual fees, you are going to be charged quite a lot. As you guys can see down here, the management fees are 0.99% per year, which is basically 1%. And on top of that, if these guys outperform the benchmark for the month, they will charge an extra 20% of whatever the actual outperformance is. Now, I suppose based on that, there is a huge incentive for the fund manager to actually outperform the index. So in a way, it is kind of good, but if not, you still have to pay that 1% regardless. Now, either way, guys, the returns that we've had a look at for this ETF are pretty good, but once again, we don't have too much history for them just yet. Now, the last and final ETF on this list is ASX EIGA. This is the Income Generator Fund by eInvest, and again, the main focus of this ETF is on that regular monthly income, and they're also aiming for a massive 7% per annum income return, which is made up of 5% cash dividend yield and 2% franking credits, as you guys can see. And this ETF tries to invest in companies that are growing in dividends, and the ETF includes somewhere around 30 to 40 different companies. And based on this graphic here, you can see that some of the big holdings are of course the big 4 banks and a few other companies as well, like Wesfarmers, QBE and so on. Now, the fees for this ETF are a bit better than before. They're 0.8% per year, and there's no performance fee, of course. And the main focus of this ETF is on the earnings. So the advantage here is that you will get a higher return than term deposits or savings accounts, but of course you will be getting much more volatility as well. And if you're retired or if you're a pensioner, you will have more income capacity at the cost of higher volatility. Now guys, out of all the ETFs that we've discussed on this list, if I was to invest in each one of them, I would probably invest in this one or IMPQ, given that in terms of my risk to return profile and what I like, I think those two ETFs might match what I'm looking for. I personally haven't invested a single dollar into these ETFs just yet, but I am still doing my research for the time being. But let me know what you guys think. Is this something that you would buy into? If you enjoyed this video, I've made a full playlist right here, which includes basically everything to do with ETFs. I've got the top 5 ETFs from Vanguard, BetaShares, iShares, VanEck, all these ETF providers. So do have a look. There's some really interesting ETFs right here for Australians, and there's also a few individual deep dives on some ETFs as well. And guys, thanks for watching. Please like and subscribe, and I'll see you in the next one. Bye now. Now this ETF is